And then the future slides, there'll be another 22 of them, will address kind of each of these points in more detail. Clearly the world, led by the US and the return of Trump 2.0, the US will look inward. There will be reciprocal tariffs, and again, those are wins, and it will be handshakes and bartering and pure chaos. Universal tariffs, the 25% import tariffs are going to be implemented early March with our neighbors in Mexico and Canada. So that is going to be a massive impact. I think to just jump immediately into that, let's go down to point 8. And that is there a pending U.S. farm crisis? So many of you probably have heard of Project 2025. It was disavowed during the Trump and Kamala Harris runoff to be president. Does anybody know who the OMB director is for the U.S.? That is the author of Project 2025. If you have not read Project 2025, basically what it's going to look at, and I will get to the point of why this matters for palm oil and biodiesel and biofuel, but if anybody has read this, CRP, the Conservation Reserve Program for U.S. farmers, that is to be eliminated. Crop insurance subsidies to be cut. What do you think the U.S. farmer is going to do when you have to start looking out for your own survival? Do you think they're going to say, yes, we are going to support biodiesel renewables? No, I want to keep my crop insurance subsidies. No, I want to keep my CRP. And yes, I want to keep ethanol. What happens with the U.S. renewable diesel and biofuel policy in the next 12 months will grossly impact, severely impact, soy oil and just the psychology of the market. Period. And again, inward looking. Freight, we're largely sideways, not really that interesting. China, I'm going to show you some graphs. China's very questionable regarding demand. And if we take any lesson with the graph I'm going to show you, is look at what is happening with grain import demand, and imagine what that might look like for soybeans, or soy meal, or even edible oils in the weeks and months and years ahead. Because it has been China, largely, that was such the massive demand driver since really 2005. As it was preparing to join the WTO officially. The global grain import demand. Again, I'm going to talk about some grain because I think there are lessons to be learned and applied to soybeans, to the other oilseeds, and again, certainly edible oils. Now, I will also fully admit and posture that until palm oil returns to a normal price relationship, which would suggest a discount to soy oil, it's difficult actually to be bearish or be short any of the edible oils. I fully stand with that. However, there are things on the horizon that suggest that relationship, and those prices might adjust much faster. We'll talk about currency. I think currency price relationships, especially the US dollar, will be exceptionally important for 2025. We've already seen some pretty dynamic shifts. The Russian ruble, the US dollar, it went from 110 at the start, at the end of 2024, the beginning of 2025, it's now at 88 to 1. The Brazilian real, it has gone from 6.2 to about 5.75. We're seeing changes in the Canadian versus US dollar, Aussie versus US dollar, the euro versus US dollar. So those price relationships will be very important, especially, and in particular, the US dollar does what it did under Trump 1.0. The BRICS, Indonesia, congratulations, you're now a member of BRICS, as I understand it, or will be. Certainly, this is an incredibly dynamic component to world trade. I think it'll be very interesting how it kind of comes out in the weeks and months ahead. Again, as the world, do we step away from globalization and look inward? Or do we believe that trade is a positive for all the economy? We shall see. Weather and Washington, I think, are going to be the two dub words for 2025. Obviously, Washington will be very important. Again, just given the chaos and volatility and administrating by tweets. And then, of course, weather, because we deal with renewable commodities, and in the grains and oilseeds specifically, we have a crop coming every 6 months from the northern hemisphere to the southern hemisphere. Most of these slides I'll go through pretty quickly, but I think this is quite interesting in terms of the economy tariffs on the U.S. versus U.S. tariffs on them. This is of particular importance, again, given Trump 2.0, reciprocal, reciprocal, reciprocal. Guess who's going to pay the price on that ultimately? It will be the U.S. consumer, and the U.S. consumer that was promised that egg prices would be far cheaper today when he was elected than under Biden. Clearly, that has not been the case, will not be the case, at least in the next 12 months. But hey, you voted for it, you're getting it. The freight market. I think this suggests that really the global market does have a demand problem, or a demand challenge, or a macroeconomic question marks. Again, specific to the grains and oilseeds, it's sideways. That is not bullish. And for any of my clients in the room, in 2024, I use the word bearish a lot. And to end 24 and into 2025, when I write or speak, all I say is not bullish. Because I'm so tired of saying bearish, it's just a different play. But this freight, the BDI, the Baltic Dry Index, that is not bullish. Period. China's absence. This is a look at the grain imports in the last 20 years. As you can see, really in the first decade of the last 20 years, China really didn't import much in terms of grains. And that is, the red is barley, the orange is corn, the yellow is sorghum, and the green is wheat. In a matter of 12 months, it is likely that China's import of those grains will be down over 27 million tons. Not bullish. Second to that point, and again, this will impact soybeans, and it will impact soy meal, but China's sow herd at the end of December, 40.8 million head. That was down 1.5% versus the end of December of 2023. Not bullish feed demand. What is China's government target when you talk about the sow herd? It's lower. It's 39 million head. Again, not bullish feed demand. If China is not growing, again, specific to the grains and oilseeds, you lose a massive demand driver. A warning. These next two slides look at global corn imports and global wheat imports. The most important thing in this is the green horizontal and the red horizontal lines. That is the difference between the previous year. Green means you are gaining import demand, red means you're losing it. In this year that ends on the 31st of August, world corn import demand is forecast to contract, lose more than the financial global crisis of 08-09. Not bullish. And that's corn. Wheat. Again, the more important one is those horizontal bars. World wheat import trade is forecast to drop a record 17 million tons. A record. That is not bullish. So, no, it doesn't really matter that Russia had a small wheat crop in 2425. Pay attention to this because if it's happening in corn and it's happening in wheat, and these are staple baselines, what is the trend? What is your risk when we talk about soybeans, when we talk about edible oils? We have a demand challenge that is and continues to be under-discussed and under-analyzed. Manage money. This is one of the most important factors in the market in terms of price momentum, price direction. Fundamentals tell the story, managed money gets us to where we're going. The top segment, the top right segment, that was the latest commitment of trade report. The second white box was the same report when I spoke last week. Okay? So this is a one-year change, basically. What is fascinating, when I looked at this, I kind of had a, oh my. Bean oil, so soy oil and soy meal positions are very similar, right? So the market is long about 53,000 contracts of oil, and it's short about 57,000 contracts of meal. Last year at this time, the market was short about 52,000 contracts of soy oil, and it was short about 48,000 contracts of meal. So it was short both the products. What's fascinating is May 24 soy oil futures was trading at 45 cents a pound. And the funds were short. The funds are now long, and May bean oil is only trading at 45.84. So what happens, I will ask you this to keep in mind as we talk about what happens when the market goes short or flat, and those prices are similar. Meal. Last year, again, those positions are quite similar, but last year when the funds were short meal was at 330. Meal is now at 300. Soybeans are the scary one. Last year when I spoke, soybeans were short 160,000 contracts. The record was 168. So they were almost a record short last year, the funds in soybeans. Does anybody know where May soybeans were trading last year? 1140. Today, the funds are about flat, minor long, and soybeans are 1050. What the hell do you think is going to happen to prices if they go short soybeans? Because really, the only thing that kind of feels like it's holding up the soybean market are Brazilian logistics over the next 30 to 45 days. The issue with Brazil is they have a storage capacity deficit of at least 100 million tons. It is also a rainforest. Where do you not want to be storing a record soybean crop or excess meal or corn? Especially if you don't have the space. The corn market, real quickly, the market was short of just over 295,000 contracts this time last year. May corn was at 425. The funds now today are about 87% of their record previous low. Corn's at 485. And again, the charts are starting to break down. So this market structure becomes very important going forward, especially if there's nothing, especially where the funds are gone. They need something to stick their teeth in and like tell me a story. Give me a bullish, you gotta feed the bull. I don't see a lot of fodder on the horizon. More of a reference piece, this is a great weekly chart that Pete puts out. It just kind of shows you the kind of key drivers and what the funds were doing on a weekly position. Again, copy of the presentation, and you can review it on your own. Currencies. So the challenge for many over the last 24 to 36 months was not necessarily COVID. Well, it was COVID, and it was access to credit. But the US dollar has been very, very strong. Here's a look on the left. The red line is what the dollar index did under Trump 1.0. The white line is the start of Trump 2.0. Likewise, the US has been very good at exporting inflation to the rest of the world. Printing money. And now we're going to solve it by firing people that maybe make $65,000 a year in the massacre that's been happening in Washington, D.C. No. This is a look at dollar cycles. It does suggest that the US dollar should weaken going forward. So keep an eye on this. Again, the relationship of the US dollar versus other major exporting currencies. And most important, especially when we talk about soybeans, will be the price relationship between the US dollar and the Brazilian real. BRICS expansion, again, this is probably the more interesting aspect of global trade going forward. Like, what does that look like, especially the share of GDP and the share of wealth? I mean, it's interesting. But the issue will be the challenges culturally, economically, position-wise, etc., when you're talking about a body that consists of that many countries and that many different backgrounds. So again, expansion, fantastic, but tensions, certainly. But if you are a producer, you want to see BRICS be successful, because we need a new demand driver outside of China and outside the tailwinds of China lifted many of its numbers during its boom. I've already discussed this, but this is just a great slide of how much. And I'm a U.S. taxpayer, and let me be very clear, I grew up on a farm in North Idaho. I started driving truck when I was 12, I had driven combines, I own farmland. I find it frustratingly appalling that for some reason, people that need help are the poster child of everything bad. Whether that is food stamps, whether that, SNAP, Medicaid, Medicare, all of that. And yet, if you are a farmer and you get your crop insurance subsidized, it's okay. That is a problem. But what you see here is the amount of money that is at risk for U.S. farmers. Because, again, Project 2025, cut, 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 cut. Let's go into soybeans. Real quickly, if you've heard me speak, I kind of stay away from stocks to use ratio, and I say, hey, what does the world consume every day? In the case of soybeans, it's 1.1 million tons every day. So if production declines or gains 1.1, that shifts your supply cushion. Same goes for demand. The world soy supply cushion is going to be at about 112 days. The record was when the Trump trade war with China, and that was a peak of just about over 120 days. We're 9 days. Brazil's going to be 50% harvested by the end of the month. Argentina, the rains have verified, production looks very solid. They've reduced the export tax, and not only did they reduce the export tax until the end of June, but they narrowed the differential export tax between meal and oil versus soybeans. And as a result, soybean exports out of Argentina are actually quite competitive, and we've seen that. We've seen Sino and China crushers buying May cargoes of Argentine soybeans. Likewise, the Argentine soy farmer, similar to the Brazilian farmer, is very undersold. So what happens as confidence rises in Argentina and as storage constraints or deficits hit Brazil? God knows there are already, again, interior logistics right now are a problem in Brazil. It will continue for at least the next 30 to 45 days. But the amount of selling pressure that sits over that soybean market is immense, especially if the managed money goes short. And please, tell me something that is bullish. If I have $100 million to deploy soybeans, I have to buy them or sell them. What am I going to do? What's the bullish story in soybeans? 112 days supply cushion. U.S.-China tensions, not great. China imports by USDA are at 109 million tons. The rest of the market is about 100 and less. And you still need to reduce the salary. You still have pork consumption that's pretty, I mean, it's kind of at its peak. Avian flu, animal disease, not only in the US, but certainly in Europe and other places. You got a massive supply push coming at this market. World trade. Let's go back. Corn and wheat world import trade is forecast to contract record levels, larger than the financial crisis. World soy trade is going to be at 4 million tons. The problem is, without China, or when you add China, because its trade is going to be down 3 million tons, world soybean trade is actually only going to increase 1 million tons. That's it. 1 million tons. The problem is when you go to this slide. And this doesn't include Argentina. If you take the US and Brazil, the two largest soybean exporters in the world, your production is going to be up over 21.5 million tons. But world trade, including China, is going to be up just over 1. What do you do with the 20.5 million tons that needs to find a home? Who's going to store it? Which is to suggest that the inverse that sits, well, I'm bear spread the 7th August, but there's still an inverse in the soy curve. It it would suggest that the query needs to continue to widen and actually come into play, because someone needs to get paid to carry this. Brazil rainforest storage deficit. Where does it go? Supply push, supply push, supply push. Now this is where it gets tricky, and that's a polite word. Let's see that. Okay, great. So these are USDA numbers, transparent. You can do these yourself. Somehow, the rest of the world meal demand is going to increase over 11 million tons. Remember that number, 11 million tons. China is supposed to increase, even as it reduces its meal inclusion rates, even as it reduces its salary. There's supposed to be this huge expansion. Like I tell you, in the US, what we use at that feed level is the only reason or the only way we'll increase meal in our inclusion or feed formulations if meal is at 250. 250. Meal is not there today. The other reality that you have to look at is, again, for somehow the rest of the world meal demand is going to increase 11 million tons, but the rest of the world corn feed demand is going to be down over 1.3 million tons, and the rest of the world feed wheat demand is going to be down 1.7 million tons. Now, I am not a feed specialist or feed formulation, but those numbers, even to this analyst, trader of futures and options, it doesn't add up. Which is to say, I think there is great downside risk in meal demand going forward. These are my last 3 slides: soybeans, meal, and soy oil. I will argue the red circle is where we were last year. The funds were 160,000 contracts short. They're now flat, and we're still $1 lower. Huh. So I would advocate or offer that the soybean market is simply going to return to pre-COVID levels, and we will go down to the break-even cost of production, not in the US, but in Brazil. And that's a big difference, especially if the real stays at 5.7, 5.8, or 5. And there's some that have said, oh, the real can go 7 or 5. Oh, you're wrong. If the real goes 7 to 1, you're talking about public soybean futures at 8 cents. Market structure. Where do we start? Meal. Meals perform beautifully. I have been a meal bear for a very long time, short meal. I do offer, I think you could see meal. If soybeans collapse, that will be your next leg in meal. And you're talking meal, either flat price or a combination of flat price and futures at 250. Because you have to find demand, because what can you not store, period. And it doesn't matter if it's in the US or in a rainforest, but meal does not store well. Does not store well. And crush margins are actually quite positive. Argentina, Brazil, the US, Europe, and China. Danger. Danger. Soy oil. I didn't think I would ever say this, but if I'm correct, in Project 2025 and the OMB Director, Office of Management and Budget, that's what that means. It's not Congress, the power of purse strings, no, it's the OMB. The U.S. farmer is going to have to horse trade I do think anything that is edible oil related will be what is horse traded, and therefore, if meal and soybeans go to pre-COVID levels, I would argue that soy oil could go to pre-COVID levels. And that would be a 3. I think my initial target by the end of the year, if I'm correct, and if the U.S. moves away from its, again, renewable diesel, edible oil base, not corn ethanol, because the farmers will not give that one up. You're talking 35 cents by the end of the year, especially if the farmers go short. So with that, thank you so much. Good luck. Please stay safe. And thank you so much for your time.
Thank you, Ms. Emily French, from CEO, Global Coordinator.